Morning, Chris.
Anthony Franco, as I live and breathe, how are you on this fine Tuesday
I'm doing
morning?
fabulous. I'm doing fabulous. Got to the gym this morning. Finished a big project. Ready to go do my AI training on Friday. So I'm excited. How about you? What's going on with you?
I have for you today the greatest lawyer dad joke of all time. I want you to brace yourself because it's this good.
All right, I have a really bad one. So do you want me to go first to kind of set you up to lay the land?
No, because when I say the greatest bad, it's not that great. So, What do you call an attorney that is currently suffering from the flu?
Ill
You're
something. All right, go ahead.
It's illegal, Anthony.
Illegal. Illegal. All right. What do you call a sleepwalking nun?
I feel like we've just lowered the bar this morning. I don't know. What do we call it?
A Roman Catholic. It's awful. So you're welcome, everybody. Two of the worst dad jokes ever on the podcast.
Make sure the guest is still here after those dad jokes. Do not blame them.
What are we talking about today, Chris?
Anthony, what?
Because that's all I think, because we're talking about IPOs, that's our total contribution for the entire episode. That's it. That's all we got for the show. Aman's gonna get us to where we need to be because we know nothing about this. I'm excited about it.
I know nothing.
I know nothing.
Anthony, what infrastructure do public companies have that yours doesn't? Probably quite a bit. Opto International, a mid-market medical device company, my jam, in Minnesota, spent 14 months preparing for an IPO in 2019, only to discover that revenue recognition practices wouldn't survive audit scrutiny. The deal died in due diligence, and the company sold for half their target valuation 2 years later. Today, Anthony, on How to Founder, we're talking about something we've never talked about before, ever. You and I have never even dreamed of this day. We are talking about the IPO readiness.
I can't even spell it.
Checks out. And what separates companies that successfully go public from those that stall in the process. I'm your host, Chris Franks, with me, Anthony Franco. And we are joined today by Aman Verjee. I think I got it right. Built his career at the intersection of startups and public markets. He was divisional CFO at eBay, managing $2 billion in revenue. That's a lot of money. COO at 500 startups, overseeing $500 million in assets, and CFO at Sonos when he went public, and now runs Practical Venture Capital, focusing on secondary investments. Aman, welcome. Thank you for hanging through our bad dad jokes. Do you have any dad jokes you want to throw out?
Oh, you put me on the spot. I don't. I chuckled at the Roman Catholic one. I thought that was funny. I do have
you thought Roman Catholic was better than illegal?
Yeah, I'm a recovering lawyer. I went to law school, so I don't find lawyer jokes funny. I take those personally.
That was funnier than anything Chris and I said. That was awesome.
All right. We're talking about today about this build up to the IPO. Now, we've heard a little bit about this, and but they have sold a lot of companies who've never gone this route. What do I, as a founder, if I want to build a company that is going to be IPO ready at some point in the future, what are the things I need to start thinking about now?
Well, I think the most important thing, it depends on the stage of the company and really how far you're along in the development. It is a layer of finance and legal architecture or infrastructure you're going to have to invest in at some point. I think the best way to think about that IPO process is it's the start of a journey. It's taking the company on a path that is going to include new investors that will have different expectations. And the most important thing is quarterly and then annual filing requirements in an earnings call. So the question really is, are you able to do that quarterly earnings call with the infrastructure that you have? And you're talking about how the company did. You have to publish SEC approved reports. You have to talk a little bit about the future. So it's getting into a reporting rhythm and a cadence that makes sense. And I think the most important thing is you need a CFO who can do it. You need a general counsel who can do it. So you have to have the right team on board. You probably have to have a board of directors that's organized to support those folks. You need an independent finance expert on the board, among other things. And then you have to have an auditor. And typically, when I've done it, you've worked with the big four auditors. I think the big four are something like 90% of the market share in the US. And you have to be able to put out those reports on a timely basis, usually 30 days after the end of the quarter. Most startups don't have any of those things when they get started. All that's complicated. All that is an investment. All that is, it's a trade-off between do I have another head of sales or a new salesperson, or do I hire up for a head of sales, or do I bring in a CFO and a GC and the legal and compliance infrastructure that those people will need? And usually at the Series A or B level, it's probably not necessary. But you get past Series B, you start thinking about either an acquisition by a public company or an IPO. I think that's usually a good time to start that process and thinking through team and then the reporting infrastructure around the finance team.
I think it's an interesting point because I think I've seen companies that have been later in the process that scramble to try to build that infrastructure that are not quite ready for that. And then I've seen companies that are early in the process that are an A round and have a full-time CFO. And you're like, I'm not really sure if you're building appropriately, maybe based on the needs or complexity of the business. But I think this is going to be a weird question, but I want to back up for a second and explain what a publicly traded company is, because I know that we've got very smart founders, but for the sake of the conversation, let's assume for Anthony's sake, let's explain what the public market is.
Just so you know, Chris,
actually go public.
Once Aman started talking about board of directors and CFO and I just stopped paying attention to the whole episode. I'm already out.
He's thinking about his puppy this entire time.
Good to know where I'm at. Good to know where the audience is at. We're down to Anthony's level now. All right, I'm gonna have to scroll up a little bit. Well, think of it this way: you're raising money from investors, and as a startup, your first stage is typically, I'm going to raise money from friends and family, angel investors, people who kind of know and understand the business and finance. The rule in the US is you've got to be raising as a private company. You can only raise from accredited investors. So whether you're raising from angels or investors or people who are going to put money in to help you further along, there are minimum requirements around sophistication that those people have to satisfy. And if they do, you don't really owe them very much. You don't owe them things like quarterly reports that follow certain accounting conventions. If they ask for certain governance documents, you have to give it to them. But if you don't report, for a year, and then you tell them at the end of the year, hey, my revenue was 2 million or 3 million, and I made money or lost money, you don't have to have an auditor do that. There's no other disclosure requirements other than telling them the truth and telling them what you know to be true. That's basically it. As you get bigger, you need to raise money from institutions, and some of those institutions can be very demanding in terms of their diligence requirements. They'll ask for reports in certain formats. When you do things like report revenue, you have to follow certain accounting rules. At a certain stage, you may want to go public, which means you will now have shares that are tradable by anyone, typically in the US and a lot of foreign countries as well. So your mom or my mom and dad can buy and sell those shares. Once you cross that threshold, you don't have to sell to accredited investors anymore. So there's no more sophistication requirement. But now you definitely have to follow a certain set of rules around quarterly disclosures. They have to follow accounting principles. You have to have an auditor sign off on those accounting principles. So it's a big lift in order to do that work. But at the same time, you're opening up yourself up to a whole lot of new investors who may want to invest in your company. And that typically is a very good thing.
So let's just follow this off just to finish this line of questioning. What then you have now gone public, you've initially offered your shares to this market, people have bought and sold them. But part of the rules now is that you're required then to tell the market, tell the public about what's going on inside your company. And that's quarter and annual reporting. So just talk a little bit about what are the requirements. We'll say NASDAQ company, most of the companies I know, are NASDAQ. So talk about those requirements and then what do you have to do on a quarterly basis? Again, increases the workload you have as a company.
Yeah. Here's what I would do if you're listening to this pod, you don't really know what you're getting into, which is also what causes the scramble and the last minute agitation that you talked about, Chris. But really what I would do is I would go to the SEC website and I would just pull up the 10K or 10Q report of your favorite company. It could be Apple, it could be Alphabet, it could be a much smaller company maybe in your space. If you're in the SaaS space, for instance, you may want to look at like Salesforce would be a really, really big one, but pick Dropbox or somebody like that and just see what that quarterly report looks like. It's usually about 20 pages long. The quarterlies are usually about 20, 25 pages long. The annuals are 100 pages long. And you talk about your business in a qualitative, upfront way. Like, here's what we do. Here's how we make money. Here are some of our biggest customers, stuff like that. There are some very prescribed financial tables. There's going to be a balance sheet, an income statement, or statement of operations, and then a cash flow statement. And you'll see that they generally look alike. They follow the same order, the same presentation. The words mean the same thing. And that's because they're all following GAAP accounting, or generally accepted accounting principles, accounting in the US. Outside of the US, you follow a different standard called IFRS, International Financial something. I can't remember what the R and the S stand for. Something like reporting statements or something like that. So now you have to comply with these rules and you have to do things a certain way. And all your competitors, all the companies in the space do that. So that's what you're getting into. You have to file this thing on a quarterly basis. That, as you said, you mainly talk about your business, which is how's the business going? Any material changes since the last time you filed? And then here are all the financial statements. Here's how much money we have at the end of the quarter. Here's how much revenue, profits we had at the end of the quarter. And then there's specific line items that you have to report on and account on. So it takes a while to do those reports. If you're a startup founder, you're probably doing a financial report already to your investors. But what you have to do as a public company is a lot more work. It's a lot more thorough. And maybe the most important thing is you have to follow certain rules. Like as a startup founder, you can talk about revenue and you can say we generated, $100 million in ARR. What is ARR? Annually recurring revenue. A lot of private investors will listen to that and say, okay, I understand, roughly speaking what ARR is. ARR is not a GAAP term. You can't say ARR on a 10Q or a 10K. The SEC will flag that and say, go back and tell me what your revenue was. And revenue is not the same thing as the annual value of all your contracts or whatever ARR is. It's a very specific thing that you have to identify in conjunction with revenue recognition principles, which is a whole legal thing you have to get into and report. And then you have to have a third-party auditor sign off on it. So that's really the work you have to do.
We don't even worry about revenue in early stage companies. We just worry about revenue.
Awesome revenue. I'm curious about you said something early on in the podcast. IPO is seen kind of as an exit, but is that really true for founders? It is an end game, right? So a lot of founders think, hey, I'm going to go IPO and exit the company, but it's not that way for most founders when they go IPO. Is that, am I thinking about that right? Or, obviously that you can take some chips off the table, but not all your chips.
That's correct. So for the most part, it's not really an exit for the founder. It can be. It is an exit for the early investors in many cases. As a venture firm, which I run a venture firm now, our normal MO is we invest in private companies. We will hold them until the point where that company goes public, quote unquote, and that means those shares are now freely tradable. So at that point, we have a choice as an investor. We can hang on to the shares and continue to ride the company up, or more typically what happens is we sell or exit some or all of our position. And the reason for that is we may still believe in the company. We've made investments in companies like Twilio, SendGrid, Credit Karma.
Company, we love those guys.
Yeah,
one of the first Techstars companies to go public.
Oh yeah, there you go. All terrific companies, and all companies. I would love to hold them until the end of time, because I thought they were great companies that would continue to appreciate in value. The challenge is, as a venture capital firm, you're charging fees and carry to your investors, and the reason why our investors tolerate that is that we tell them we can get you into very good private companies that you're not allowed to get into. So today we're into SpaceX and Canva. Those are going to be probably our two big winners out of the new fund. At the point where like Canva or SpaceX goes public, my investors would say to me, okay, I can get into SpaceX now. I can get into Canva now. Anybody can buy those shares that are public. I can get into Twilio. I can get into SendGrid. I can get into any of the companies we've previously invested in that have gone public. Why am I now paying you 2% management fee and 20% carry? Give me the shares if you believe in them. Tell me you believe in them, but I want to hold them from now on, and I no longer want to pay you 2 and 20. So for a lot of early investors and maybe some early employees, it is an exit in the sense that you take some money off the table. But for the CEO, if you're still in charge of the company, it's very much not an exit. All that happened was you took some old investors off the cap table and put a bunch of new investors onto the cap table. And those new investors will expect you to have a conversation with them every quarter and then do the filings and all that sort of stuff.
It's a great point, and I think it's one of the really clear distinctions that founders need to understand. Is that an IPO is liquidity event. It is not an exit. Oftentimes, an exit, you're selling your company to another company, and then sometimes you work with that other company, sometimes you don't. Sometimes they want you to stay on, sometimes they don't. That's a true exit. IPO is liquidity event, means that your investors can get cash for the shares that they invested, hopefully get a positive return on that. But it is not a traditional exit the way that we typically think about it. I want to dig into a couple points here. So I'm just going to say this because this is conventional wisdom, Mon, and you tell me if I'm on base or off base, which is why I would want to go public as a founder. I want to get to the opposite point, really, because I think there's a lot of reasons to go public. I want to know why I shouldn't. So go public, you're going to get an influx of capital, large influx of capital. Firms like yours now are investing more money later, so it's not quite as clean cut as it used to be when we were coming up. Like, hey, if you got to particular revenue amount, you weren't going to be able to raise private, you need to go public. You got ability to be more flexible in your financing. You can do different classes of stocks. You can do some interesting things in the markets, et cetera. Really, it adds additional power to raise money for you when you're in the public markets. All fair? Is there anything big I'm missing as far as like why I would want to go public? Liquidity, obviously, for my investors. Any other big reasons I'd want to go public?
Yeah, let me give you, I think you got a lot of them. I think you're missing a couple and or maybe overweighting a couple, but let me go through the list of reasons and then let's do a little bit of I heard you mention on base. So I know you are familiar with baseball. So we can do like a baseball metaphor for what's a good reason, like a home run, what's a terrible reason, like a strikeout, and then in between. So one reason that you mentioned is to get liquidity for my employees. So if I have, let's say I've got, early employees and people who've got people who are on my team, I've probably given them a salary. I've probably given them some kind of a bonus. Then I've given them stock, typically stock options, or maybe something called RSUs or restricted stock units. If you're a private company, your shares aren't freely traded on a quarterly or on an annual basis. You typically hand that stock to an employee, and that stock is restricted, meaning it's not going to trade or sell until I, the company, allow that to happen in some kind of a liquidity event. And so by going public, that is one liquidity event. And now your employees can actually take some of those shares and turn that into cash. And cash means they can buy a car or buy a house or send their kids to school. So that's a great way to motivate and retain employees. I would say 10 years ago, that was a great reason to go public. That was the home run. That was the reason why most companies went public, to attract and retain investors and employees who wanted liquidity. Now there's a whole thing called secondary markets. My firm is a secondary firm. Companies like Canva, companies like SpaceX, they actually do quarterly tender offers where they come in and they buy and sell shares or allow those shares to trade. So you can have liquidity for employees without going public. So that is no longer, that's still a good reason to go public, but maybe not the best reason. Maybe a single or a double. Another one is you mentioned is you can raise more money because there's a lot more money in public markets, and you get investors like pension funds, hedge funds. My mom, my dad can now buy shares in a public company. When we went public at Sonos, my mom bought shares. Before that, she wasn't allowed to buy shares. She actually asked me, "Can I buy shares in your Sonos Series D offering?" And I was like, "No, Mom, you can't. Sorry, you're not accredited." Accredited? What is that? Well, she's Canadian, so I had to give her the American rules and the Canadian rules. And the bottom line is you have to be worth $1 million or more to be accredited in the U.S. and buy these shares. So she was SOL. She was not able to buy those shares in Sonos. But after we went public, then she could. So opening up to new investors is another great reason.
It's just one point on that. It's self-reported, right? Accreditation is self-reported. So
yes,
you could lie, couldn't you?
You could, but if you know about it as the company, you typically, as investors, what we do is
Right.
we have to ask for a verification. If somebody lies and gets away with it, I guess that's that's possible. But when you have to clear audits, and then as a fund, you have to stick to credit investors, our lawyers will now ask us to take steps to verify. So they're making it a little bit difficult to get away with.
Didn't mean to divert you. Sorry, just curious about that.
Is doing the fundraising I'm doing now. There's actually accreditation services that send people to say where they have to validate, and they do some validation steps.
Oh, that's awesome.
When we first started out, they were like, "Hey, you rich?
Sign this form that you are worth."
Like, there was no real actual accreditation. It was just asking people.
Sorry, I didn't mean to divert you. This is keep going. This is fascinating.
No, it's good. And I think the accredited rules, by the way, in the US are being rethought. And it just seems silly and frankly un-American to say that only wealthy people can invest in startups. Like I can take my money, invest in go to a casino and bet on red, but I can't. My mother's not allowed.
I did want to ask you about that because there is Reg CF, right? That allows companies to go out and raise from what, for lack of a better term, everyday investors, not wealthy investors. But there, I've actually gone through a Reg CF round, and it's kind of a pain in the butt too.
Public. Like it's that level. It's not quite that scrutiny, but it's a lot.
Yeah, you can do it up to. There are limitations though. You can raise from, I guess, crowdfunding, or you can I think that's what CF stands for. And so you can do it, but you can raise only up to 5 million in capital.
Yeah.
And you can do it under, general solicitation rules, which means, again, the rules on what you can say. If you go over a certain number of investors as a venture fund, I'm not supposed to go over 99 accredited investors before I have to list with the public. I think under Trump, they raised that to 250, but again, there are limitations on that. And now it's up to a couple of thousand investors. So they're liberalizing the rules, but still not quite as open as if you're a public company, you can sell however much you want to whomever you want.
Whoever you want. Yeah.
At PayPal, when we went public in 2002, this was the number one reason why we went public. It was liquidity for employees, and also, hey, we can raise a lot more money than we're able to in the private markets. And we had great investors in the private markets. Sequoia led our first couple of rounds, and we were able to raise a lot. But we were a public company, and then we were able to raise a lot more. I would say here too, this used to be a home run answer. This is now maybe a double. There are a lot of companies that can raise money in private markets now. That wasn't true 10 years ago. The three biggest companies, I think the three biggest startups in the world now are SpaceX, Anthropic, and OpenAI, just based on market cap. If any one of them were to do a round in 2026, they could raise probably 20 to 25 billion in a Series H or whatever that's going to be for those companies. The biggest IPO in the history is either Alibaba, which is a $25 billion IPO, or Saudi Aramco, which I think got to 25 billion with some help and support from the Saudi government, shall we say. But I think either SpaceX, Anthropic, or IPO could go public next year and raise 25 billion or more. I think they could all raise 25 billion in the private markets too. So for a lot of companies, the availability of private capital is a lot higher now than it was before. And that may be a reason to stay private and not go public. But it depends on the company. There's certain categories that are going to be a lot easier to raise for in the private markets. Public markets right now will probably have certain demands on things like SaaS companies. They have to be profitable, growing at a certain rate, and you actually may be better off staying in the private market. So I think those are two reasons. Those are both good reasons, but single to double. The last reason to do it is actually the reason one of my companies wanted to go public in New York. They saw it as a branding event, a credibility. It was a marketing company. They were in a very competitive space, and they thought being public would give them some cachet, some brand name recognition, selling to some of the enterprise clients we had, just telling people, hey, we're a legit company. We've been here for a while. We're well capitalized. We will be here for the future. We are regulated. We have auditors and the SEC looking over our shoulder. If you're in fintech or maybe areas like that, healthcare maybe, those may be ways to signal that your company is for real, takes regulatory compliance seriously, and has longevity, and maybe your investors and your customers want that as well. So I'd make that another reason to consider going public.
I'm curious, Aman. So you're in the secondary market. So you're going after companies. So I don't understand. I frankly don't understand the difference. So is secondary is what you do like once you've raised a couple of rounds of venture, you go to you guys before you go IPO, or tell me where the secondary market fits into this whole fundraising experience for founders.
Yeah, sure. So take a company like SpaceX. So the first round they do, they are raising money from investors who invest directly in SpaceX. That's typically called a primary issuance, meaning the company is the issuer and they bring in new investors. Okay, fast forward, 10 years, or SpaceX now is almost 20 years old. They do another round. Whenever they need to raise money, they're doing primary issuance. That's how they raise and finance the company. Then they get to be profitable, and now they don't really need to raise more money. Well, those early investors who invested in 2003, 2004, 2005 have been holding now for 15, 20, 25, coming up to 25 years. How do those investors get liquidity? They could go to SpaceX and say, hey, can you buy me out? Well, companies don't typically do buyouts of their own investors because, companies need money. They're raising money. They're not in the business of sending money back to shareholders unless they're very, very profitable and have a track record of profitability. So what does SpaceX do? SpaceX says, hey, go to Aman and Practical Venture Capital. They will buy out those existing investors at whatever price the market charges. So we're not investing directly into SpaceX through a primary issuance. We're buying out their existing investors in a secondary transaction that takes them off the cap table and puts us on. That's the difference.
Got it. So it's not a way to raise money for the company. It's a liquidity event for the employees.
Exactly. Yep.
Got it.
Employees and maybe early investors. Yeah. Exactly right.
So do you ever get into a situation where the company doesn't like their investor and they just want the investor out? Is that interesting? That's
a great question. I think, Anthony, you're a lot smarter than Chris thinks you are, but that was a very clever.
I'm not that bright. No, I just.
I used to think that for years.
Exactly. No, that happens a lot. Sometimes a company gets into it with an investor, and the investor you thought was right at the Series A is not right for the company at the Series H. They have a board seat. They're annoying. They have certain rights or obligations that around reporting requirements or whatever that you no longer want to meet. They're no longer the biggest investor on your cap table. They've now been dwarfed by the later stage capital, but they're still annoying. They're asking the most questions or have the most diligence requirements, or maybe those are all, I guess, reasons to want an investor off the table. Another very benign one is the investor's been around for 15 years, and that investor decides, we now want our money back. Our fund is over. We're shifting our strategy. We want to make new investments. Our investors are getting anxious. I left the company, but we need liquidity at some point. We have a 10-year timeline on our investments, and now here we are in year 15, year 18, year 20. Please take us out at fair market value and bring in fresh capital with a different time horizon. So those are all good reasons why those early investors will want to sell.
Amazing.
Steve, that is a terrific question. And classic example, Anthony, is that I have, my kids go to college, and I've, taken less money to work for this college, or work for this company, but now I need to, somehow get some cash to work for college. All right, this is the bigger question, and it is different than when I was coming up, and probably, Anthony, you were coming up as well. There is now more reason to not go public because of the availability of larger scale growth capital later. There was no such thing as D rounds back when I was coming up. If you went to a D round, it's like, what's wrong with the company? It's probably but like now you're E, F, G, H rounds, these incredible rounds that are coming later. And I think it's showing that institutional money is willing to play private longer. Why as a company, why as a founder, would I not want to go public?
Yeah, if you can raise, I guess, let's say you can raise a GHI. What does the company do when they get to Series Z? Do they go to AA or
I don't know.
Greek alphabet?
I'm sure we'll get there soon.
Beta?
I'm sure we will.
I think SpaceX will have to, or maybe OpenAI will have to, we'll have to eventually figure out how to code those rounds.
Yeah, they're going to just start. It's going to be like the iPhone. It'll be, the X.1 or something. Like it'll be
right. They'll start renaming the rounds. Series Chris, Series Anthony. They'll start naming them like our, like our hurricanes or whatever. So why would you not want to go public? Well, I think there are a couple of downsides to going public. One I've already alluded to is you have to have the right team and the right infrastructure. it costs a lot of money to go public. You can do it when I went through the process in 14, 15 for an ad tech company in New York. We paid at least $2 million in accounting and legal fees just to file all the S1s, get them pre-approved for the SEC, get them approved for the SEC, and sort of set up the roadshow. And then every quarter you now have a full-on finance team. You've got $100,000 a year in audit fees. You've got legal fees on top of that. So that's just an overhead and expense. And a lot of founders just are like, why do I want to spend that money on lawyers and finance people? Some of the loveliest people in the world and my friends are finance people and lawyers, but for the love of God, that's just a lot of money for a company that's not generating, you're supposed to be generating money that goes into product and marketing and technology. And that's maybe a distraction. So that's one, it's just the cost. The second is just the reporting requirements are pretty invasive. Like you do have to tell the world whether you're profitable or not, whether you're growing or shrinking. You can't hide the ball on any key metrics. And so you're sharing a lot of maybe competitive information, segment reporting, profit margins, new product strategies, what products are working, what products are not working. If you did launch a product you're very proud of, how much revenue, is coming from that product. If it's material, you have to disclose that stuff, and you can't hide the ball. So you're giving up a lot of competitive information. That's the second reason why maybe you should think about going public. And maybe the last one that you should really think about if you're a founder or CFO is your stock price now trades every day. So every quarter, you're going to be subject to the vicissitudes of the public market. And you can have a great quarter and, just miss expectations, miss guidance. Maybe there's some broad macro news that comes out about, I don't know, China or something. And God forbid a lot of your product or a lot of your supply chain goes through China. All of a sudden, investors will assume the worst and could trade your stock down. So you may have a stock price that's worth $50 one day, 75 the next, and then 25. As a private company, you can control your valuation, your share price. And there is some value to that. When I was at Sonos, that's a private company, we did one round at $3 a share. We did the next round at $9 a share. We didn't have a lot of daily volatility. So, our employees were not distracted. They just knew the share price used to be $3, now it's $9. Any new employees come in, get a option struck at a $9 share price. Once we went public, the share price bounced around every day. So we'd hire some employees one week and they'd get a strike price of $6. Then the stock price went up, and the next week we'd hire people that have a strike price of $12, and then the stock price went down, not because of anything we did, but because there was some announcement about supply chain shocks and in China where we did a lot of our manufacturing, or Amazon launched some kind of music service that was a competitor to us. Now our stock price is back down to $7. We have a bunch of new employees whose strike price is $7. So it just creates, ongoing disconnects between your comp strategy, your accounting. You've got to stay on top of it. Maybe your employees get distracted, day trading your stock, God forbid. All that is solvable, but you have to really build a culture and a team that can withstand that. And that's something that, it's just not a muscle that a lot of companies have. And a lot of them just don't have that stomach for that volatility.
This is the heart of this line of question is there's a lot of people that I know that have not wanted to take their company public, where they stepped aside as the founder to bring in the professional manager because it is a different job. You're now having to speak and think about stock price. It's not about building culture and team and great products, et cetera. I think that's just speak to briefly, in your experience, what is the job of an executive, as a CFO, as a CEO? How does it change when you're public versus when you're private, or does it? Maybe it's a misconception.
It can. It's definitely a different job. It has a new skill set. I think that's fair. Some of the folks I worked with very early were Peter Thiel and Elon Musk. Those were the founders of PayPal.
I'm not sure who those people are. Who are the? Could you?
Do you want? You can look them up. I think Elon.
Look them up.
Yeah, I know. I think they're both pretty famous, but I will say they were both great CEOs, great leaders. I don't think Peter wanted to be a public company CEO. So soon after we went public, he left the company. Elon has had an on again, off again record with being a public company CEO. I think he likes the spotlight. He doesn't like the SEC scrutiny. So you've got to be a little bit more. Elon can sort of do whatever he wants to because he's a special case. Most CEOs have to be very careful about what you say about the company, how you market. You can't reveal certain financial information except for during certain windows. There is a Reg D, Reg Fair Disclosure, which essentially means if I say one thing about the company to one person, I now have to put out a press release telling everyone, all my shareholders, about a new product or something else, a deal we just signed, or something that's material to the company. So there's a certain level of discipline and focus and communication that now becomes a part of the job. Someone like Mark Zuckerberg, I think, is quite good at it, but even Zuck was like, that's just not what I'd like to do. So when he decided to go public, he was like, I want to focus on the tech and building the team and the culture and making Facebook work. And he brought in Sheryl Sandberg, who had more, who was the COO, I think, maybe the president was the title eventually. And her job was more to interface with the investors and make sure that the rules were being followed and the compliance. He brought in a CFO who was also very good. And so you could, and Sergey and Larry over at Google did the same thing. They were both founder first mentality, tech oriented. I want to build stuff. And then we need someone like Eric Schmidt to kind of be the face of the company, the CEO, while we're in the public company phase. And so typically what a lot of good founders do is they just add someone, a president or a COO who can, or a CFO who can be that person who makes sure that the rules are being followed, investors are being communicated to in the right way at the right time, and that that frees them up to focus on what they want to do.
Aman, I've always heard that CEOs of publicly traded companies have better hair than I do.
Right.
Yeah.
Jeff Bezos.
It's true, but he had hair when they went public, so
He lost it, I guess. Being a public company CEO probably cost him his hair.
trading company. All right, so let's kind of go through the conversation. I think this has been a really interesting one because I think that there's so many misconceptions out there about, on both sides of this equation. What type of company right now? So actually, one more question on a smaller question, because this is important. There's this idea of timing in markets, about the IPO market and when you can go public, when you can't. Company in Denver, by the way, terrific company called Ibotta just went public last year. I saw them at Denver Startup Week. I was one of the judges. I thought it was a terrible idea. I awarded it to the startup that was out of business 6 months later, and Ibotta went public. So that's how much I know about early stage investing. But talk to me about the timing of IPO markets, because we hear this all the time, and I'm not sure we as founders understand what that means and how it affects us downstream in funding.
Yeah, it's a little bit of a, I don't know, it's a little bit of maybe a misconception, but I think the general notion is that the IPO window opens and closes, and as it opens, then you can go public. And if it's closed, like it seemed to be closed in 2000, 2001, when the dot-com market crashed, it seemed to be closed in 2022, 23, when virtually nobody went public. Then all of a sudden, you don't have the ability to go public, and so your investors may lose a chance to get liquid or have their exit. I think that is largely true. Usually there are signals when the stock market is rising, when the volatility index in the stock market, there's something called the VIX, the CBOE volatility index, which is a measure of essentially how much are shares moving around in the major indices. When that thing falls below 20, it's usually game on, and the stock market is rising, that's usually game on. I think we're now in a situation where it's game on. Companies are able to list, are able to get public, and those offerings are successful as long as they meet certain criteria. There are also periods when, the volatility index is really high or the stock market is falling. So like 2022 would have been the general consensus in 22 is that the IPO window was closed. That said, there were some successful public companies at the end of 2022, like Instacart was able to get public. Klaviyo was able to get public in 2000. I think they were in 2023. So there were a few examples of companies that defied the common wisdom and got out, but it's a lot harder. And a company like Instacart got a valuation of $10 billion when their last private round was $40 billion. So my advice to CEOs or CFOs who ask me is usually it's really hard to time the market. There's always a chance to get out and get liquid and get public. It just depends on the valuation. So that's going to be a concern. And if you're valuation sensitive, you may want to, try to wait until the conditions are more favorable. But PayPal was also, we went public in 2002, and I think the general consensus was the IPO window is still closed. And Peter Thiel.
Your story is famous because you made the market, right? Like it was such a big deal.
Yeah. Well, we were able to go public at a $1.5 billion valuation in 2002. And now the company is worth, I don't know, $70 billion. So that also means that 69/70ths of all the value created at PayPal didn't go to Peter Thiel and Elon Musk and, and all those, and Sequoia and all those founders. 69/70ths of it went into the public markets where people like my mom were able to benefit. But the downside of that is when you go out, the valuation may not be great day one, and you have to, be credible and meet your numbers and hit your numbers, and then the market will take care of itself. And a lot of founders don't want to take the risks about, I'm going to have an IPO and the price won't be what I want, and then it's a down round. And what I just tell them is, okay, so it's a down round. So what? So you raised at a $5 billion valuation last year. You'll get priced at a, I don't know, $3-4 billion valuation on the IPO. Who cares? Like on the next day, the price will go up or go down. You're going to be locked up for 180 days anyway, you and your employees. You are in this for the long term, right? You better get used to the share price being up, down, sideways. Like, don't take that. The market is what it is. It'll set the price. You don't set the price. The market sets the price. If you have a good company, you deliver on your results, and you do well, the long-term value will take care of itself. When perfect example, when Facebook went public, they were arguing with their bankers trying to get to a $100 billion valuation. I don't know why Zuckerberg wanted to have a $100 billion valuation. I guess that was a big round number. Their last round was like 45 or 50. They held out. They priced the IPO perfectly. They got to $100 billion. Within a couple of months, they fell to, I think they were down to 45 billion. Like, they traded down almost 50% from their IPO peak. And now they're a $1.5 billion company. So, in the long run, their investors have done great. People who try to hot trade the IPO on day one or day two maybe had a couple of bad days, and then those who bought and held have done great. So as I think as a shareholder, you appreciate a CEO who's like, I'll get the company public. Good times or bad. The price may not be perfect on day one, but if we execute and do the right thing by our shareholders, the market will eventually reward us. And so I would advise founders and CFOs to focus on the long run value and not try to time the window perfectly, because that's really hard to do.
You actually answered my last question, but I want to ask one more follow-up question on this.
Yeah, go ahead.
So I've heard VCs say, "Oh, I'm not going to give a seed round because it's not a good IPO market right now," which always seems completely foreign because you're 3 years out minimum.
Right. I'm not going to have any children because college it's hard to get into college right now.
Expensive.
Yeah.
It's bizarre to me, but it's actually something that founders hear. Why do VCs care about IPO markets when they're making investments that are not going to come to fruition until 3 to 5 years later?
Yeah, I don't know. It seems silly. If your timeline is really for a seed investor, my advice to you is you should have a timeline of 10 years or more. That's how long it takes companies that get started now to get to the point where they can go public. And the perfect example would be the ones like, SpaceX has been around for 20 years. Airbnb was something like 18 years to go public. And so these big outcomes take longer than 3 years to go public. If you're trying to time something to only 3 years, that's probably not the right time frame as a seed investor. And you definitely can't predict the public markets 3 years out. You should be thinking about the one thing you may want to think about is, what are the valuations? What's the entry price I want to get at? If I know where the IPO market is today, and I have some view as to what it's going to be 3 to, let's say, 10 years out, I can kind of work backwards on what the entry valuation ought to be. So I can have a good conversation with the founder today. Like, I think you're overpriced, because here's what I'm underwriting to. I want to have a 5x return on your company. So I'm going to tell you what I think you're going to go public at. We can talk about that and why, and I can work back to what a 5x return for me and my investors would be. But just saying I'm not going to invest, because the IPO market is down today, therefore I'm not going to, invest now in the seed or early stages. Just seems like you've got the timing all wrong.
Yeah, I think that, and I'm going to, maybe put words in your mouth, but it also feels like this is really the course of this conversation, which is, if you build a great company with sustainable revenue, has good growth, all those fundamentals that we've learned in business school from day one, you're going to have multiple opportunities. One of those may be public, but understand what you're getting into. Is that a fair summation of what we talked about?
Yeah, I think that should be that's the best advice to a founder, is think about the quality of the business We would really advise them to focus on the customer problem, make sure the technology is something that the customers need and stands out. And then the public markets will typically reward that. There are definitely cases where you can build a great company and the public markets will, they'll be in a position where the public markets maybe don't appreciate the value the way that you think they should. There are certain categories maybe that are, that are difficult to trade in the public markets because of either regulation or, just the way the capital is forming in a certain country at a certain time. So you want to think about that, but then there are other ways to get liquidity as well, secondary markets or M&A. And so we kind of go through those different, scenarios with our founders. And if you're just trying to build something to take it public and you're trying to time it, perfectly and focusing on that marketing layer of it, thinking of it like an exit, for all the reasons we've talked about, I think that is the wrong mentality for a founder to have.
I just want to ring the bell just once, and then they can fire me the next day. I just want to do it one time.
Well, I got news for you. You can't even do that anymore. If you list on the NYSE, I guess you can, but the NASDAQ, it's just a buzzer, which I found out.
Yeah,
so that's boring. You literally push a button. You can't even ring the bell. You push a button. That seems very anticlimactic. So if that's your motivation, you should have a different career.
Yeah, maybe you're from Canada. Maybe like in Canada, I don't go public in Canada where there's like I just want to be able to ring a bell. That's all I really do.
Yeah, the TSC 300. I think that's a buzzer too, though. I think even that's not ringing a bell anymore.
All right, Aman, are you ready for the speed round? All right, I'm going to ask you a series of questions. Just answer the first thing that pops into your head. What percentage of your finance team should have public company experience as you're scaling up to go public?
Oh, I think that's probably, I'd probably say 25% minimum.
Hire a Big Four auditor early or wait until you're very serious about going public?
I would probably have the conversations early, but hire them maybe 2 years before you want to file.
I like it. Revenue predictability or growth rate, which kills more IPOs?
Which kills more IPOs? I think that's a good question. I would say in the first year, revenue predictability is really important. So get that one right 4 quarters out. Don't screw that up. And then after that, it's probably growth rate.
This is my favorite question I'm going to ask you. Your general counsel says you're not ready, which of course they're going to say you're not ready. And your banker says you are, because of course they're going to say that you are. Who do you believe and why?
Fire the general counsel and go for it.
That is the correct answer. Yeah.
No, I would never take legal advice and just dismiss it. That is I would have to dig into both and evaluate both. But if your GC is saying you're not ready, you gotta take that very seriously.
The answer is just hire a better CFO, because you don't want advice from either one of those people. Really, that's a bit of a false question. All right, Deep Dive Resources, the IPO Playbook by Philip Dorr, and the Financial Shenanigans by Howard Schilt. However, there is a better book that will be available on bookshelves near you. Amazon bookshelves, on your website, someplace in the next. You said 3 weeks, Aman, right? So
exactly.
So that's what we're gonna do, and the book is.
So my book coming out is A Brief History of Financial Bubbles. It will be available on bookshelves, but also on Amazon and wherever finer books are sold. If you want to get on the pre-order list, you can go to bigbubbletrouble.com and read a bit about the book and get on the pre-order list. The book is a financial history book. It talks about the 10 biggest bubbles in financial history. It starts with the Amsterdam bubble in 1636 around tulips.
I love that story. It's one of my favorites.
It's just unbelievable. And I cover the South Sea bubble in 1720 and the Mississippi Company in Japan in the 1980s and railway mines in 1845 and the tech bubble in 2000. So you learned a bit about good bubbles and bad bubbles. A lot of what I wanted to do with it is I'm a fan of history and economics, and I think just literacy on that is good. You don't have to be a PhD in economics to read my book and learn about bubbles. You don't have to think about asset pricing and asymmetries. This is just about what caused the bubble. Why did prices of tulips go up and go down? Why did it happen in Amsterdam and not Paris or not London? Are there patterns that recur among the bubbles? Are all bubbles bad? Some of them are positive, some of them are negative, and I kind of draw the distinction why. So there's 10 different bubbles, 10 different chapters. each chapter is probably, you know, a hour read, and then you'll learn 80% of what you need to know about the tulip bubble in one chapter, and you can always learn more. So that book's coming out in about a month.
I am hitting submit on join the pre-sale right this minute.
Good for
Can't
you.
wait to read it. It's going to be good. It's amazing. Hey, really great conversation today. We really appreciate you joining us. I think it's one of those things where it's not voodoo. It's not, you know, it's understandable.
You demystified it for us quite a bit. Thank you.
But for most of us that are founders, it's just this big world that we just don't spend a lot of time thinking about. So I really appreciate the conversation. Awesome stuff. Anthony, get us out of here.
Yeah. So real quick, come on, stick around if you can for a second after we close the show. For all of you tuning in, thank you all so much for listening. Please be sure to visit us at howtofounder.com, where you can connect with us on LinkedIn and subscribe to us on our YouTube, Apple Podcasts, Spotify channels. And please be sure to smash that like button or the subscribe button on YouTube.
If you like
you guys,
if you don't, yeah, I mean, then don't worry. If you like the conversation.
Are you done, Chris? Sorry. All right. You guys listening, forget what Chris just said. You're the pioneers of economic prosperity. We are all so grateful to be there along the way with you. See you next time, guys. Thanks, Aman.